Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, May 9th, 2017. I wanted to share a indicator, custom indicator that I've created. Some of you might find useful incorporating into your trading. And essentially what it is, and I'll get to how to replicate it. Down here on the bottom, it just shows you the percent difference between the price on any security, be it a commodity, a stock, an index, an ETF, whatever you're charting, and a particular moving average. In this case, we're going to use a QQQ, as you can see in the upper left-hand corner. This is a 3-year daily chart, so a daily time frame, and I plotted it with a 50-day exponential moving average. Now, you can use any type of moving average you want, simple moving average, front-end weighted, whatever. It'll do the same thing. And again, it will simply calculate the difference. Right now, for example, you can see 4.310. So the Qs are trading 138.26, which is 4.3% above 132.55. That's where the 50-day moving average is. Now, um, the reason I created this indicator, I couldn't find it on any charting platforms. Most of you probably incorporate moving averages into your trading or investing in some way or another. There's pretty much one constant that holds true in trading, and that is from time to time you get strong rallies, or we'll call them rips, where prices move so fast they walk away from a particular moving average. As we did back here, we had this arrow. We got quite a bit above the 50-day moving average. Right before then we had tested the moving average. Sometimes certain moving averages will act as support or resistance. Here it acted as support. We moved away from it and got quite a bit stretched, and we came back in. We call these mean reversions, and typically the more impulsive the move, in other words, the farther you get away from, in this case, the 50-day moving average, the more violent the snapback is. So think of prices when trading a security a lot like a rubber band. Regardless of the trend, whether it's an uptrend or downtrend, when you have these sharp rips or dips, that rubber band, the farther you stretch that rubber band, the harder it's going to snap back. And that was the case here. We had a drop of 10.4%. Then we got very far below the 50-day moving average. You can see down here that we were about 6% below back then, and we had a very sharp snapback rally, and we came back above mean reversion, came back to the 50-day, and then some. Got stretched again, went well above the 50-day moving average, and then had a sharp correction back down to it. And then we traded around it for a while, and the 50, for the most part, acted as support as we went on a more, it was somewhat choppy, but a somewhat more controlled uptrend. Okay, so that's something that really holds true with just about any security. Again, you want to look for those periods where prices are very stretched. Just because you're at a certain percent above or below the moving average, that's not a buy or sell signal. In fact, I wanted to talk on that. When I first put this custom indicator together, what I was looking for, I wanted to see, I figured there might be a certain threshold level where when prices get so stretched, in this case above the 50-day, that a correction ensues. Likewise, I was looking for a threshold on the bottom. What I did add a threshold line here. You can see it. It's about at the 5 level, give or take. There's a thin, it's a blue dotted line. If you need to have a pretty decent resolution on your monitor to see it. I didn't make it very big. Here, I'll draw it out for you just in case you can't see it. So this, for the most part, was the upper end threshold over the last 3 years. You can see there's only one point the prices got significantly above it. We popped barely above it there. We hit an extreme right here back in late in the fall of 2015. We got about 6% above the 50-day moving average. And as logic would dictate, that extreme came right around the high and one of the biggest drops that we've had in years in the market because we got very stretched. However, and let me just finish. On the bottom, I was looking for a low-end range, and we had roughly, you could draw a line here. Where is that? Around the 4.5% or so level. You can see a couple tags of that level which produce reactions. But the problem with the threshold levels is they are not very accurate timing indicators. And a lot like the RSI, which measures overbought or oversold, and I often say this, The problem with that is overbought can become a lot more overbought or can stay overbought for an extended period of time. Case in point, here we stayed, and again, this isn't the RSI, but RSI, if you cross under 30, you're oversold. And here's a case where the 50-day moving average was well below prices were well below the 50-day moving average for an extended period of time. So had you gone long at this point of the threshold, you would have been in for more pain. The prices went lower in the Qs, and they stayed that way for, a couple months. Here was a case we went far below it, and there was a pretty sharp snapback rally. We kissed it again, hit that threshold. So again, it's almost hit or miss whether you want to use these thresholds. So let me tell you where I found value. The thresholds are certainly a heads up, and that's why in this case I'm just looking at pullbacks. If I tried to show you all the buy signals, this chart would just be too busy. So we're focusing on pullbacks, and I'm doing that right now because prices are stretched, and I do have a pretty good I won't call it a sell signal because I always say sell signals come on break of support levels, trend lines, chart patterns. Divergences are just a warning sign to be on the lookout for a very likely trend change. That's all it is. Divergences can continue to persist and grow, but until and unless they're taken out, they almost always play out. So what I've done down here on the PPOs, I've given you that threshold line that I just covered up top. That's around the 5 level or so. And what I noticed is that when you hit that level, you do get an initial pullback, but not really a tradable correction. In other words, when I say tradable, I'm not talking day trading. I'm talking swing trading. That's my primary trading style. Swing trading is typically holding for several weeks to several months. And, a couple weeks to several months. It all depends on the security. So here's all the divergences. So you have the first initial reaction high in the Qs. Then you have a second reaction high. You have a reaction high in PPO and a lower high. That is the definition of negative divergence. Prices making a higher high against any indicator making a lower high. And so what I've done, every single arrow on this chart marks every divergent high in this indicator. So what I've come to find is that prices getting stretched or well above their 50-day moving average in itself, like we had here, although those are good if you want to, use this threshold. If you're a quick trader and you want to just scalp a couple percent, 2, 3, 4, maybe even 5% pullback in the Qs, that's been pretty effective. Again, just stop the video and take this chart or replicate it yourself, and you'll see that. However, the swing trade opportunities come on the divergences. So let's talk on that. For the most part, they're all standalone divergences that resulted in corrections. However, back here at this period, this was a very strong, pretty resilient uptrend, although it was a choppy uptrend. There were trading opportunities on the long and short side. So what I've done here is marked a series of divergent highs. In other words, this was our first divergent high. Prices making a higher high, and you did have a correction. Now, I didn't measure these out. Here's the measuring tools that I used on all the other drops that we've had following the divergent highs. You can see them all there measured out. Without fail, they all played out for corrections ranging from about 5.5% all the way down to 26% in the Qs. These were all about 5%. You can see here's a 5.5% drop. So the drops that we had following each of these divergent highs were roughly along those lines. You can see there, there, there. However, I often talk about consecutive divergences. When you have consecutive bullish or bearish divergences, in this case, these are bearish divergences, each of those smaller divergences, which played out for, we'll call those relatively minor pullbacks, resulted in one large divergent high. In other words, from this point here, this peak in the PPO, to this peak, that is the large the primary negative divergence, we'll call it. I'll just use that term. So you can see the strong divergent high. That resulted in the biggest drop that the Qs had throughout the entire bull market from the March 2009 lows. I should say the Qs actually, they were the only ones that bottomed back in late 2008. So over 7 years, the biggest drop was preceded by this very large divergent high, a series of these smaller divergences. But These other ones resulted, again, corrections. Here's a drop of 10%, a drop of 18%. So that's where I find value in this indicator is look at the thresholds. That's sort of a heads up, but you want to watch for divergence because in almost every instance, at least every instance on this chart, after that peak, we pushed up, made a new high. This was a pretty small divergent high. We had a peak here, another reaction high, a little pullback, another reaction high there. You can see the small divergence I have drawn here, and an even smaller divergent high right there. But yet a divergent high, and resulted in that one small divergence, but it resulted in a drop of 8%. So here we are. That's it. We've come full circle. Very clear negative divergence. You can see a lower high in the percent of stocks, or the percent that the Qs are trading above their 50-day moving average, I should say, and prices. And it's very steep. This is a steep divergence. This is what's scary. From my experience, you have the sharpest corrections come from either very prolonged, extended divergences. This one didn't have a very strong slope on either line, but it was a series of those 4 consecutive divergent highs. In this case, we have very steep divergence. Look at how the sharp advance in the Qs right here against the percent of stock, or the percent that the QQQ is trading above its 50-day moving average. All right, how to make this indicator, and again, use it on anything you want. I'm using stockcharts.com here. So what I did is you pull up a PPO, that's the price percentage oscillator. Let me scroll down. Okay, for those of you that use stockcharts.com, down below, you simply go here to the indicator box, add PPO, which I've done. So click on, you get the drop-down menu, select PPO. The default will be a 12, 26, 12. Is that what it is? Here, let's pull it up. PPO. Here, I'll load another one down here. PPO 1226.9 was I thinking. There's the default. So you just go in and change the settings to 1, 50, and 1. And you can add it above or below. So that, and just click update, and that's what it'll do. Now we already have the indicator on there, so let me get rid of that and just leave things the way they are. And that's it, plain and simple. You want to add a horizontal line at the 0 mark, you can do so here. Just do overlay. Scroll down. I'll have to move here. I'll select horizontal line, parameters at 0, update chart. I might have to move the page around after it updates. Yep, sure do. Okay, and there it is. See the 0 line. I don't really, some people it helps to have that visual mark, but again, look for the divergences. And here we have, I know you guys are probably sick of hearing about the divergences I've been highlighting on the indices, but they're there now. They exist not only on this indicator, they exist on the 60-minute time frame right now on the Qs. I'm talking the MACD, the PPO, the RSI. They exist on the daily time frame, so that's something to look at. And now, real quick, for those of you that use TC2000, I assume you can do it on freestockcharts.com. You can do the same thing. I've created it down here. Here's the Qs up top. Busy chart. I have all the divergent highs marked here using the PPO as is with the 12.26.9 default settings, the RSI 14. These yellow lines just show you, I've talked about this. We still have negative divergence on the daily time frame, as I just mentioned. You can see it there. Looks like the PPO is starting to roll over. And I put these yellow lines because that just shows you that prior peak. If we take out these yellow lines, the prior reaction highs, then we've taken out the divergences. But right now we have divergences across the board. So let's just get rid of these two. I just want to show you the divergences were there. And so here's that same custom indicator that I just talked about on stockcharts.com. I could actually go in here and change the scaling a little bit. Edit scaling, center on 0. Let's do auto scaling. Auto scaling might look a little better. That then takes away some of that white space. Okay, how did I create this? Pretty simple. I'm going to do it for you here. Click Add Plot. Type in PPO. Oops, I did that wrong. I typed in PPO, but I hit enter right away. I needed to select PPO, the indicator. Pick the first security there. Right down here, price percent oscillator, PPO indicator. Ditch that 9 EMA. Stock charts won't let you ditch the the exponential moving average, and it won't let you plug in a 0 for the value either. That's why I had to put a 1. However, you're going to get the same result whether you use a 1 or a 0. So let's just remove that. We don't need it. Go to the PPO, hit the drop down box, edit, and simply plug in 1 for your short period, and then whatever period you want on the EMA. In this case, let's just do a 40. We can do a 40-day moving average, whatever your thing is. Well, we'll keep it simple. We'll go with the 50. That's what we did before, just to show you the numbers should be the same. All right, color it whatever you want. I had it orange above. We'll do this one yellow. And what's nice about TC2000 is you can change it. So I named mine percentage above 50 EMA. And again, with TC2000, you can choose any type of moving average you want here, so whatever your preference is. And that's it. And therefore, go ahead. Like I showed you a second ago, I removed that. I like to do the on scaling, set it to auto, and it takes away some of that white space. And again, just use these. You can set a threshold line. It's easy on TC2000. Okay, you can see this is where that one period I talked about back in 2015 where we got above about to the $6 level. But for the most part, this has been our threshold here. You're going to notice a shortcoming on TC2000. The line won't populate right away. That's a nice thing about stock charts. See, TC2000 only calculates what it sees on the screen up here, and it takes a while to calculate any type of moving average because you need prior past periods. So pretty much it's not taking anything to the left of this chart to calculate it, and that's why you have this little void right here. So in this one instance, stock charts does a better job. You're not going to have that white space there or the blank spot, but the value should be the same. And again, you can put your horizontal line. Let's just make that red. There's your threshold. That gives us a heads up. But again, as I mentioned, as I highlighted before, that in itself is not a buy signal. It's usually when you see the divergence. So then we want to start to look for divergences, especially after hitting the high end of that range. And same thing that I've already drawn out on stockcharts.com. You can compare the two. And so there we are. Bullish case, if you're bullish, let's see if these divergences are taken out. Like I often say, divergences are potential. We need to still see on the regular PPO, we need to see the PPO make a bearish crossover to put in that lower low. I'm sorry, the lower high to confirm the current negative divergence that's forming on the daily chart. But if we take out that previous reaction high right here, this one, then we no longer have the divergence, and you can't make a case for a impending trend reversal. Until then, I can. I went a minute ago, I showed you 3 years of history on the QQQs without fail. Every single divergent high resulted in a correction, as I think I said, ranging from 5.5%, all the way to almost 20% or so. So there it is, just one more. Call it. I can't put a nail in the coffin yet because we haven't had the correction, but these divergences continue to build, and until they do, I continue to believe the risk reward remains clearly skewed to the downside, meaning sure the trend is bullish in the Qs, but that doesn't mean you want to jump on board at this point because I see limited upside compared to the amount of downside, and the sharper these divergences form, the sharper the ensuing correction is likely to be. Okay, hope you found this useful. If you guys have any questions, shoot them to me. Every charting platform is different. Some don't offer a PPO, and now that I say that, if my logic is right, I don't think it's going to work on a MACD because a PPO is a price percentage oscillator. MACD is a moving average convergence divergence line. I don't think that will give you the numbers in percentage terms, how far above the how far above the moving average or below the moving average that the security is trading. So hopefully you have a PPO to use. And As always, if you guys have some custom indicators or anything that you use, please feel free to share it with me or share it in the trading room. I'd appreciate it. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.